G'day, fools. Scott Phillips here from the Motley Fool. I am our Chief Investment Officer in Australia. We have made it. Made it a few things. Made it to the end of earnings season. I've got a bit of work to do once I finish this video to catch up on where we've been. A couple of companies I've still got to update my coverage on. But also, we made it to the end of Financial Literacy Week, or at least the beginning of the end, or maybe the end of the beginning, I hope, for some people who'll take some action as a result of today and this week. But we are at Friday. This is where we wrap up the Financial Literacy Week that was, and also hopefully answer lots of your great questions. So I am really, really hoping you're going to fill up that question box, the comments box. I hope I'm going to have to race through them. I hope there's so much great content that I struggled to fit it in. If not, I'll sing, dance. You don't want to find out what I'm going to have to do to fill time. Put it that way. So this is Financial Literacy Week. If this is the first time you've joined us, thank you for joining us. There are the other 4 videos on our YouTube channel. You can go back and watch all of those. I'm not sure if there'll be an email sent out at the end of this series with links to them. Maybe there will, maybe there won't. If there's not going to be, our marketing team are now having a small heart attack because I've changed everything. No, they may or may not do it. You can find on YouTube, just literally jump on the YouTube channel. The one you're watching now, you can click on, don't do it now because you'll go away from the video. Click on the little, was it a channel name at the bottom? And you'll be able to access that. Was it? Yeah, at the bottom it says Motley Fool Australia. If you click on that later, you can get to our the rest of the videos on the channel. There's heaps of good stuff, by the way, and more coming. I've already teased that. It's going to be start next week, actually. Not because of this, just because we were supposed to, and financial earnings season got in the way. So we are going to start rolling out some more YouTube videos from next week. Not all live, some live, hopefully, actually. Team doesn't know this yet, but I'm hoping to do some more live stuff because I just love it. I love interacting with our members, our readers, and in this case, our viewers. G'day, Mark. Thank you. My wife hasn't earned anything this financial year. We'll get to that in a minute. Also, by the way, if you are watching this, please let me know. Make sure it's working. Otherwise, I'm talking to myself, and nobody likes that. So thank you for spending a bit of time. All right. I'm slightly concerned. I'm hoping this. Oh, Keith, tell me you're watching this live, Keith. The little screen here says people waiting to watch, and yet it looks like it's live. Okay, lots of questions coming in. I'm going to assume we're live. I'm going to assume we're going. I'm going to keep talking. If this isn't live, no one's going to tell me. So if you are watching this live, at least one person. Good. Thanks, Elizabeth. I apologize for my lack of professionalism when it comes to YouTube Live. I'm learning like everybody else, and you don't get a sense of what's coming out. All you can see is what I'm doing and the chat comments coming in. So thank you. Nice. Thanks, Hal. Thanks for giving AusBiz a miss. Apologies to the guys at AusBiz. This is better. No, I'm kidding. This is good anyway. Thanks for spending some time with us today. Right. So guess what? My usual disclaimer. This is general advice only. You've heard it 4 times this week. This is the 5th. Remains every bit as true as it was on Monday. I have to say it each time. Why? Because it's important. And if you only watched this one, you don't know it. I've got to say it. So you can get 2 types of advice in Australia: general financial advice and personal financial advice. They are what they sound like. Personal financial advice is not what we do at the Motley Fool. Why? Because we provide some content to lots of people. Personal financial advice is one-to-one. And if I was going to provide personal financial advice, I'd need to be appropriately licensed and accredited. And I would need to understand your skills, your abilities, your temperament, your skill, your risk profile, all the good things, goals and objectives, as the cool kids say, so that I could tailor that advice to you. I can't do that. So this is general advice. I will say, I think company X is a buy. You have to decide whether it's right for you and your portfolio. That's how this works. So I will talk in general terms today. Even when I'm answering questions, they will be general answers. Please don't assume, well, because I answered your question, I've considered all of your personal circumstances. I haven't, I can't, I won't. And this is general advice only. Thanks, guys. Thanks for letting me know it's live. Yeah, so that's what we do. Who is the Motley Fool? If you're new to us, the Motley Fool provides financial advice, but in the way of general investment recommendations, as I've already said. We do recommendations, stock tips, stock picks, whatever you want to call them. That's what we do as that core business. We help our members hopefully find investments that can beat the market. That's our objective in almost every single service, with one exception. I won't get into the detail here, but that's what we try and generally do. We also provide education and advice. Not personal advice again, but for our members, often people some have been investing for 45 years, some are just starting. And so we try and make sure we provide not just the ideas, not just the recommendations, not just the names of the companies, but full write-ups, full coverage, and ongoing coverage. So if we decide we want, or we think our members should sell a stock, we'll tell them. They should buy more, we'll tell them that. It should be on hold because they should either buy or sell, we'll do that as well. It's pretty straightforward, right? It's what we do. But also we try and give you information about the market, about the economy, about finance in general, and investing in general. We want to help you become better investors. Yes, we're giving you the fish, but we also want to teach you to fish. And so we try and do combinations of that. We started 1993, 32 years ago in the US. We've been here since 2011. Our purpose, our kind of the corporate slogans changed a few times. Originally, it was to educate, amuse, and enrich. That's sort of a soft spot in my heart. We went through to help Australians invest better, and we now arrived at helping you become smarter, happier, and richer. And that's kind of a hark back to the very original one. Educate, amuse, enrich, smart, happy, rich. You get the idea. Basically, that's what we're here trying to do. And this is about, frankly, trying to help more Australians than just our members. We have a broader goal. The Motley Fool has a foundation in the US, actually. We've got no action out here yet. It's only relatively new. But we have a bigger mission than just trying to make money for ourselves. We try and do that, of course. But really, it's about helping people learn to invest better. Paid members, readers, viewers, that's what we're trying to do. So that's us. If you are wondering, it's not a plug, it's not an ad. It's just because it's important that you know this. What I do want you to know, though, what is important is we don't get paid by anybody other than a very small amount of advertising revenue. I think it's just on the podcast at the moment. Not entirely sure if we take ad revenue anywhere else. Either way, that ad revenue never, ever, 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 ever impacts on what we do or don't do. I've knocked back ad reads before because I don't like the product. Others, I kind of go, well, that's a product that's not something I'd necessarily buy, but they're sponsoring the podcast. It is what it is. But it absolutely has never, ever impacted, will never impact the advice that we provide to you, either in this forum, to our readers, or to our paying members. We are completely and 100% independent. If it ever became an issue, I just tell the advertiser to get nicked, basically. So if they don't like what we're doing, I'll give you a quick heads up. I read a credit card ad the other day. I won't tell you the company because they're not sponsoring this one. And I don't like credit cards. And I'm going to say it on the podcast whenever I want to. And if the credit card company doesn't like it, they can just not go away. I don't really mind. So not because I'm being, by the way, over the top or trying to be, argumentative or just, we'll if they want to advertise on our podcast, someone else's podcast, that's fine. It's not going to change the editorial decisions, by the way. Unlike the Washington Post, there's a bit of editorial for you. Let's move on. Financial Literacy Week. Simon from Townsville. Awesome. Thank you for joining in, mate. Had a few from North Queensland. Yeah, Noosa the other day from memory. So Townsville. Might have another Townsville in yesterday. Don't know. Let's go through. So what I want to do, basically, if I get enough people who ask really great questions, I want to spend most of my time answering those questions. So that's actually what I really want to do. But up until then, we've got one from Elizabeth and one from Mark. So two questions, or three, one from Keith. So excellent. Three questions I will absolutely tackle. I was going to say I promise. I tell my bloke, I don't promise anything I absolutely can't be sure of, so I will absolutely try. I promise I'll try really, really hard to make sure I answer those three questions, guys. If I don't, then, I don't know, throw something at me. So let's go through what we did. We had 4 days of Financial Literacy Week before today, and they were the 4 key pillars that I think are most important for anybody watching. They're not everything. They can't be everything. They're 4 hour, I speak fast, but there's only so much you can do in 4 hours. It's general in nature, as I said, as a matter of course. So we've done our best to sort of set the pillars up. Now, we started on Monday with myths and mindsets. And I want to remind you that investing can be done by anybody, both literally, as in, I checked up, by the way, CommSec Pocket is one I've mentioned before, an app that helps people get started. You buy one of 8, I think it used to be, maybe it still is, pre-mixed investment options. You can invest as little as $50 and brokerage starts at $2. So there you go. If you got $50, you can be an investor, right? So it is available to anybody. And as you add money regularly, of course, those costs come down, your portfolio grows, and we know the long-term future is incredibly bright. But the first thing I want everybody watching to know is you can, and I think should, be an investor. There is no reason not to. Don't let inertia stop you. I mentioned earlier in the week, the old Chinese proverb, a journey of 1,000 miles begins with a single step. It's just true because it's true, right? And if you don't take the first step, you can't finish the rest of the 1,000 miles. Please do whatever you can. I talked about some options on Monday. Again, please go back and watch that full video if you want to. But very quickly, find a low-cost broker online. Look at their website. Don't go for the cheapest price, and be Chess sponsored. Do that. Pick a broker. You can't go too far wrong. I've said before, and this is not a plug, I use CommSec, I use Perla, I use Sharesies. There's lots of other ones out there. Have a look at those 3. If you're kind of like, it's fine for you, Scott, where do I even start? Start with those 3, not because they're the best, just because they're the ones I use and I know they're good. And that might be enough, right? You don't need to absolutely pick the eyes out of this one. Find a good broker that is going to do the right thing by you, has lots of good educational content, and a site that's easy to use. That's as hard as it needs to be. Set up your account and then put some money in the account. They all work differently. With Sharesies, I have to send money to them first and then make the trades. CommSec take money out of I have a linked bank account. They take money out of that and then use the trades for that. Perla, I can't remember. I think I sent them money. I got to make direct debit actually with Perla. There you go. So 3 different ways you can also do it, right? So yes, have a look at one of those. Have a look at all of them. Choose which one's right for you. Please, 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 please start. I can't tell you that strongly enough. In terms of myths and mindsets, a few things. Prepare for volatility. Know that the market will be volatile. It just will. You can't pick the tops. You can't pick the bottoms. It will be volatile. That's the ticket to, I say all the time, volatility is the ticket to the dance. It's the price of admission. It's what you have to accept if you want to invest. But by the way, as I've said so many times, over 30 years to the 30th of June last year, according to Vanguard, and this is just the most recent data they've got, the new data is not due out for another 6 months, 10 grand invested 30 years earlier became $130,000, not in the absence of all the bad stuff, but despite all the bad stuff that actually did happen, right? Go back to 1993. We had the Y2K bug. We had the Asian financial crisis. Does anyone remember that? That was in the late 90s. We had the Bali bombings. We've had the GFC. We've had the COVID crash. We've had, I don't know how many presidents and prime ministers, economic growth and declines, the first technical recession in Australia in more than 30 years. And yet 10 grand became $130,000. You didn't have to do anything. In fact, you had to do exactly nothing. Leave the money alone. By the way, if you added regularly, you had even more than that, right? That's just one lump sum up front and then do nothing for 30 years. If you added regularly, that money grows and you can get the sense of it, right? So really, really, really cool. Please be an investor. Not for my sake, for your sake. If you use the Motley Fool, great. If you don't lose the Motley Fool, that's cool too. Please be an investor. So you can do it. It doesn't require specialist knowledge. Buy an ETF if you don't know what to buy. An exchange traded fund. Here's the phrase I want you to remember. Broad, low cost, index based. So broad and index based, kind of the same thing, but a broad index, right? So maybe I'll turn it the other way around. So with low cost, keep that management expense ratio, MER, as low as you possibly can. Don't pay more than you have to buy the assets that you want to buy. The Vanguard ones are 0.03 and 0.04%, like fractions, like 4 cents and $100, right? Literally, what 1% would be $4, 0.1, 40 cents, 0.01, 4 cents. So what's 0.03 is 12 cents. 12 cents per $100. I mean, seriously, that's just cheap as chips. So that's the low cost bit. Don't pay more unless you have to, unless you really like it. Broad index based. Passive investing is about getting the return of the market. There are so many ETFs out there. Now you can buy an ETF that has a leverage bet on gold or a leverage bet on the market crashing or everything else out there, right? Don't get sucked into that stuff. The marketing on this stuff is great by the ETF providers. They're called product manufacturers for a reason. They're making things for you to buy. They're entitled to. It's perfectly reasonable. It's free market. My recommendation, my advice, find the really, really low cost, broad index based. Index based, which indices, as I said earlier in the week, the ASX 300, ASX 200, S&P 500, total US market, total world market. Those, think how broad that. I'm not saying don't just buy the ASX 20 or ASX gold, or I mean, do if you want to. But my advice: get started. If you don't know what to buy, if you don't want to buy individual companies up front, jump into ETF, get started, start investing. Then if you want to branch into individual companies after that, you can. And you can absolutely do that. We'll give you some advice if you want it. But if you don't, again, do it yourself. Find someone else to give you advice. That's not what this is about. It's not a plug for us. It's just to say, hey, get started with ETFs at least, because it's just easy, right? Yeah, just do it. Okay, time in the market matters. We talked about compounding. Rule of 72. I don't think I actually mentioned the rule of 72. If I did, it was on Monday and I've forgotten it. The rule of 72 tells you how long it takes you to double your money. It's really, really simple maths. You take the 72 divided by your average return you expect or can get or have been getting, and the result, the number of the end of the equation, is the number of years it takes you to double your money. So let me do that in maths. If I got 12% a year, 72 divided by 12 means your money doubles every 6 years. It's not a rough rule of thumb, but it's pretty good. 72 divided by 12 is 6. If you got a 9% return, 72 divided by 9, your money's going to double every 8 years. Now, here's why I want you to keep that in mind, right? I've talked about 30 years. I want to go even further for a second. Let's say you can get a 9% return. That's been the long-run market average. So let's go with that. If you started with, what do I start with? I'll start with $1,000 because it's easy. And you double every 8 years. I want you to do the maths with me. So let's double for 40 years, okay? So we double the first year, the first 8 years, we've got $2,000, $4,000, $8,000, $16,000, $32,000 after 40 years. Now, you know how I said time was important? That last double, right? Remember, 2, 4, 8, 16, 32. The last 8 years, you double your entire portfolio. Or put another way, if you had an 8-year longer time horizon, you'll end up with twice as much money. If you start 8 years earlier, you end up with twice as much money at the end. Now, again, I can't promise that's going to be the average return, by the way. So again, I try to be really clear there. I'm not allowed to, and I wouldn't give guarantees or promises because anything could happen. The world could end tomorrow, right? But it's not going to. So keep that in mind. But that's why that's so powerful. Now, by the way, 1 to 32 grand, you got 32 times your money in 40 years. Add another 8 years, though. Let's say you can start 48 years. And again, you're saying, well, hang on, I'm 25 now. How can I have 48 years? You're going to still be alive by then. You'll be 73. I know that feels weird, right? But and you're probably at that point still have 20 years to live. So again, think about life expectancy. So 1, 2, 4, 8, 16, 32. No, hang on. 2, 4, 8, 16, 32, 64, 128. If you manage to get 56 years of doubling, 128 times your money, right? Some people think, oh yeah, what about inflation, Phillips? Okay, let's say inflation is 3%. Here's my question to you. Are you better off investing or not? The people who say that normally say, well, yeah, well, it's lower than that because you got to allow for inflation. They're absolutely right, 100% right. Of course they are. But I also then ask, well, okay, so that's less. What else are you going to do with your money? How else are you going to get a better return? What else is there better to do with the money that's left over after you've paid your living expenses and had a bit of fun than invest for your future? Now, if you get a higher return, that's great. By the way, you know how we started with $1,000? Let's say we start with $2,000 just for fun, right? 4, 8, 16, 32, 64. So yes, the number is still double, right? So with 1 ending with 32, same with 2 ending with 64, except the extra 32 grand, the double at that end, is worth the extra contribution up front, right? So please invest the money up front as much as you can afford reasonably and safely and responsibly. Don't go without food. Make sure the kids have got clothes. Do the right things. But if you can put anything aside as early as you can, let time do the work. And then again, add regularly as you go. I don't have enough fingers. I'm not clever enough to add money as I go, but you get the broad idea, right? I'm not going to, I could play silly, but I guess I'm not going to. You get the idea. You're smart people. Please, please, please take advantage of compound interest. My sheet's reset for some reason. Here we go. So mindset matters. That's the absolute takeaway. You can do it. It is possible. The returns are there. You will have volatility, but the long-term return is absolutely worthwhile. Save as much as you can, as early as you can, for as long as you can, and get the best return you can. Roughly in that order, actually. I was going to say that's the secret. It's not a secret. It's a discipline because you got to actually do it. That's the hard part. Not knowing it, doing it. That's the hard bit. Talk about budgeting. Budgeting is foundational. If you're not a budgeter, I'm not saying you must budget my way or anyone's way. Let me actually take that back. Budgeting is not foundational. Having money left at the end of the month is foundational. Or, even better, putting aside money at the beginning of the month or the week or the fortnight, whenever you get paid, that's the foundational bit, right? Because that's where you have money left over or put aside originally before you even start spending to build your nest egg. And you must have that money left over. All the discipline in the world, all the good intent in the world does not matter. If you earn $100 and you spend $100.02, you're going backwards. If you spend $100.01, you're going backwards. If you can earn $100 and spend 90, that's where you start to make progress. So, as I said on Monday, I think it was, Tuesday actually, please find a way to put a pre-commitment device in place. Ask your pay office to pay into 2 separate accounts. If you can't do that, the day after your pay gets in your account, you can set up a direct debit. Put hopefully at least 10% if you can manage that. And some people can't, I get it. But please make decisions, by the way. If you think, well, I can't do it because I've got an expensive car to pay for, yeah, you might have to make a decision, right? I can't do it because I want to go out to concerts. That's cool. If that's what you choose, just know that you are taking it from future, in my case, future Scott, by doing that. That's, again, it's no judgment. You do what's right for you, but just recognize there is a trade-off. So when the money comes in, get at least 10% put into a separate investing account. Never, ever touch that account, right? Either at the beginning or at the end of the month. Talking about ways of budgeting, talking about ways of paying off debt. There's plenty of people watching now who will be in consumer debt. Not necessarily too much debt. Afterpay or other buy now, pay laters, credit card debt, personal loans, whatever it is, get those paid off as quick as you possibly can. Because here's the thing, as much as I love investing, you're almost certainly definitely paying more in credit card interest than you can earn on the market. Absolutely. You're probably paying more on personal loans than you can earn in the market. So get rid of them. I want you to invest. But before that, I want you to have your financial foundations solidly built. And that means getting rid of your debts, paying them off as hard and fast as you can. Make a game of it. Pay the smallest debts off first, so you feel like you're making progress, and the repayments on that small debt goes to the next one. So you're paying larger repayments, right? Because you've saved the money from the first one, and you're getting ahead. The snowball is building. Or the avalanche, we talked about again on Tuesday. find the highest interest debt, pay that off first, just because that's going to kill you most financially, and then move to the next one and thereon. Whichever way you do it, please get rid of your debts. Please cut up your credit cards. I mentioned that before. I read a credit card ad. Please cut them up. Don't use a credit card. If you think you need to, you don't. You can use Visa debit cards online. You just do not need a credit card. Please don't fall for that one. It's lovely rhetoric. The banks are happy for you to believe you don't need a credit card. If you've got one, fine. And people say, by the way, oh, well, I use it responsibly. That's cool. And some people do. Most people do. Just why have the temptation? You don't need to, right? What's the advantage of it? I don't think there is. We kind of feel, well, I got at a bank who gave me a credit card when I was in university, right, at a part-time job. Speaking of irresponsible, I felt like I was an adult. I've got a credit card. I spent a lot of money on that credit card, and I spent a lot of time paying it off. I've been there myself. Please don't do it unless you can. Well, you can avoid it. So I'm not even going to say unless you can't avoid it. You can. Please don't do it. Pay for your debts. Budget responsibly. Investing is not complicated. I've just kind of talked a little bit about that. Buy some ETFs, buy some stocks on top of that if you want to. Add regularly, be diversified. Follow those rules, buy quality businesses if you can find them at good prices. If you don't know enough about that, do some reading. You might have to do a bit of reading to learn to be an investor. We'll help you at the Motley Fool again if you want it. It's not an ad. Go somewhere else and get some advice. Go and grab the Barefoot Investor. Scott Pape's a great guy. There's some great resources out there. Just do that. Scott doesn't do a lot of investing stuff. It's mostly personal finance, but wherever it is, I'm just picking him as an option. Go and find a way to learn a bit more about investing. But if all you do is buy ETFs and go fishing, go for it. That's going to do a fantastic job of building your wealth. And we talked about super yesterday in the long term. Please use super responsibly, which means contributing as much as you reasonably can, while still giving yourself some optionality. Invest a little bit outside super. So if you want to retire early, get some money, use it for something else. You can't get to super till you retire. It's appropriate, right? It's what's supposed to, well, 60 these days, but you're supposed to be able to get to it because it's supposed to be for retirement. So if you want to have some flexibility, some optionality in your life, grab some money outside super and make sure you stick it there. All right. I got some other thoughts, but there's lots of stuff here that I've got. I'm going to try and look down at my screen in front of me, see if that works. All right, let's go from the top. Mark, my wife hasn't earned anything this financial year. If we put money in her super from our joint account, does she get any money back at tax time? I'm not aware that she does, Mark, but I am aware that there is a government program that allows spouses to contribute on behalf of their non-working spouse and get a tax break themselves. So the tax break would be for you, potentially, again, not personal advice, for the person contributing on behalf of the non-working spouse, not a tax break for the spouse themselves. I'm not a tax accountant. I'm not a super specialist. So again, please get advice. Jump on the ATO website. Look up spouse contributions. I'm pretty sure that that's true. Again, please check the sources before you act on anything I say ever, but certainly here and certainly about superannuation. I believe you can make contributions for your non-working spouse and get a tax deduction yourself. That's my understanding. It may be that you get more money put in super. Maybe it's government match. I'm a bit hazy, mate, a bit fuzzy. But there are definitely benefits, and you should definitely look at them, because if it's money for jam, it's money for jam, right? If the government's going to match your contribution or add or pay less tax as a result, hey, more money in your pocket. So have a really good look at that one. Keith, stop losses for share investing. Keith, I'm going to disappoint you. I've never, ever in my entire life used a stop loss order, and I intend never to use one ever again in my entire life. That's not common wisdom. By the way, the Motley Fool is set up to kind of be a little bit different to the rest of the financial markets, not deliberately, not contrarian. We're not contrarian for the sake of it. We just don't kind of necessarily follow everything else, everything everyone else wants. Why do stop loss orders exist? The official answer will be to minimize your chance of losing money. The real answer might be closer to because a stockbroker thought they could sell you another way to make you trade. That's a little cynical, but not much. Here's the thing with stop losses, mate. They don't lock in your price. Wise Tech fell 20% earlier this week. So software company, for those who don't know the business, if you had a stop loss 5 or 10% below your last price, it would have fallen all the way past those because the first traded price was 20% lower. So the stop loss didn't stop you making that massive loss, is the first thing. Second thing is, a falling share price isn't necessarily a reason to sell. Sounds silly to say, but if the share price falls then rises again, if you sell it at the bottom, you've just locked in the loss. Now, if you want to sell because you think the business is no longer viable or the investment thesis is broken, then great. I would suggest you do it manually. And again, I can't say what you should personally do, Keith. I'm saying you a lot. I mean you as in all of our viewers, no personal advice. I've said this for years, by the way. It's exactly the same thing I've told everybody ever about stop losses. You're locking in the lowest price. Now, if it falls further, you kind of feel good you've done it. But you can probably do that manually. And again, because you can't set it exactly at the price you want, if the share price falls 3%, sell my shares. If they fall 10, 15, 20%, You sell at whatever the first traded price is that day. So you're locking in a much lower price than you thought you were getting in your stop loss. And again, if the price recovers from there, you miss out the recovery. In my opinion, you're far better to simply say, I don't care what the share price has done. All that matters is what's the share price now and what does the future look like. If you look at that and say the share price fall was justified, I'll use WiseTech as an example. I don't mean to be critical or supportive. I don't have a strong view on WiseTech. If the share price falls, and I look at it and go, that looks too cheap, I'll buy some more. Why would you want a stop loss to stop you out? If you look at it and go, well, it fell 20%. I thought I was going to get about 5 or 10 below. I look at it now, I'm really uncomfortable with it. I'll sell the shares. Then you've sold about the market price. You're far better setting up price alerts with your broker. Some offer them, some don't. Some, I don't know if the websites still offer them. They used to. I know CommSec does. I use them, as I said. Others may. I'm not pushing CommSec at all. Yeah, you better set up a price alert. So if the price falls to a certain level, it tells you not, hey, I should sell now, but hey, I should look at this and see if I feel good or not about me that I own and the price it's currently trading at. A lot of my companies, if the price fell, unless the news was terrible, I feel better rather than worse. Why? I'm a long-term investor. If I look at a company I own, I'm looking at 5 years and saying, at that point, do I think, firstly, the company's still around? It's important. Secondly, is it bigger or more profitable than it used to be? And third, at that point, would I have liked the opportunity to have bought the shares at today's price in 2025? The answer is yes, I'm buying the shares. Now let's take, I think I mentioned JB Hi-Fi earlier in the week. I'll do that one again. Let's say JB Hi-Fi's share price falls 20% tomorrow, right? And I look at that and go, well, it's not going anywhere. And the result was not great, but not terrible. And I think in 5 years' time, it'll be bigger than it is now. And the share price will probably be higher. I'm happy to own the shares. I'm probably going to buy, I said probably, I might well buy more if the price fell 20%. So just be careful with stop losses. Don't let the market tell you what to do. There's a great line from Ben Graham, Warren Buffett's mentor. He says, make the market your servant, not your master. Let it inform you, not guide you. I think that's the right quote. Basically, the idea is take its information, don't take its advice. Elizabeth, is it best to have property and SMSF neutrally geared and invest funds elsewhere or pay off as much of the loan as possible? That's really hard, Elizabeth, because it kind of depends on what happens next share price-wise and asset-wise. The best way to think about paying money off the mortgage in general, or any mortgage, including an SMSF, is what is the return I'm going to get by paying it off early? And that is the saving in interest. At the moment, you're probably paying 6.5-ish, 6, 7, something like that. Am I going to get more investing elsewhere that covers that gap? In other words, if I get 9% outside my mortgage or 6.5% by paying it off early, I'm better off to actually go and get that 9%. 2 caveats. 1, you're always better to get ahead on debt so that the bank doesn't come calling. 2, whatever investment returns you get that aren't interest savings are taxable. So be mindful of that taxable nature. So if I compare a 6.5% return, as I just said, on saving money on my mortgage versus 9% in the market, then I'm going to pay 30% tax on that 9%. Well, guess what? Kind of back to 6. So it really does matter. I would suspect over the long term, interest rates are lower than this on average over the long term. I would suspect market returns are better than this on average over the long term, better than 6.5. But honestly, right now at 6.5, I think it's a pretty close run thing. Again, long-term averages versus the current interest rates, probably relatively line ball. So again, you do you. I don't know what you should do. When interest rates are lower, far, far better to invest, in my opinion, statistically, than to pay the mortgage off. Not because it's guaranteed you'll get a great return, but thinking probabilistically, if I'm paying back in the day 2% fixed on a mortgage and I get 9% in the market, it's a pretty easy decision for me. Again, I can't guarantee the 9, but statistically, if that's what I'm likely to get, then I'm probably going to play the game that way. If rates would go up to 8% on mortgages, then of course we probably have a recession. But at that point, it'd be easy to pay off the mortgage and pay down. Rather than invest outside property. The access, yeah, Elizabeth, you asked about the access in the recording of the last 4 days. I think I covered that after you might have asked the question. It's on the YouTube channel. I don't know exactly where they are. I'm not going to try and play silly, I guess, on my computer while I try and talk at the same time, because there's a not insignificant chance I screw something up. So our YouTube channel is, if you click, don't do it now. After I finish chatting, actually, I'm going to left click on, I can do this. Here we go. This is live too. Okay, so it's youtube.com/ at the @ symbol, Fool AU. So youtube.com/ @ symbol, Fool AU. And I can actually see it here. They're all sitting under Financial Literacy Week in that category. There's details there on what you can watch. So yes, please go and enjoy those after this. Stay here for now, if you wouldn't mind. But after this, yes, you can absolutely go and watch all of those. Plus this one as well, that'll be available. Daft Monkey. Okay. Great. A newbie to financial lingo. Thank you for asking this question. I really appreciate it. Is any bank account that gives you interest an account that is compounding interest? Yes, it absolutely is. What happens is the bank will pay, let's say they pay you, these days probably quarterly, right? So you got $100 in the bank account at the beginning of the year. 3 months later, they've paid you some interest for that quarter. Now, frankly, at-call interest is terrible. So please look at a high-interest savings account for money you don't need to transact. In other words, if you're paying bills out of that account, you want to have it there. If it's money you're not using for a while, you're saving, you're putting aside, a high-interest account, you might get 4 or 4.5%. I'm going to use 4 because it makes my maths really easy. 4% a year is about 1% a quarter. So after your first quarter, your 100 is now 101. The next quarter, the bank will pay you interest on the $101. And that's what compounding is, right? Because your $100, original $100 is earning you another quarter's worth of interest. And the extra dollar you just got also gets the 4% interest. Now, that's only 4 cents to start with. So the second time you're getting out, you get 102, whatever the number is. But the one after that will compound away. So yes, anytime you are paid interest or dividends or some sort of return, and then you leave that money there, the next lot of interest is paid on the higher balance. So you get this nice little step up over time. So yes, absolutely. That's what all the compounding is letting your money stay there and earn more returns. The money you get paid, dividends, rent, rent's harder to compound because you can't really reinvest back in the property, but you get what I'm saying. Any returns you get from your investments, if you then invest that money, your money is making money and that money is making money. And that's what compounding really is. What features should you look for in an account for long-term savings for the emergency fund? Really, really great question. You don't want a term deposit for your emergency fund because if you're locked in for 3 months, you don't have to pull the money out after a month because the car broke down, right? You lost your job. So I love term deposits generally, but they're not for emergency funds. You want a high interest at call savings account. Think about the online savers. I haven't looked at any of these recently, so I don't know. ING, Rabobank, most banks themselves have a high interest option. Jump on the bank's your bank website, do it. Plenty of comparison sites, CanStar, Finder, there's plenty of others as well. You can just look up high interest or best high interest at call savings account. Google it. You get lots of ads, but you'll get some comparison sites. Go through and have a look. Some pay only if you deposit money regularly. Some pay only if you maintain a high balance. There's no single answer to that. Work out how you usually save and what that balance is likely to be and where you're going to get money from it. So that's really important. I will say far more important than that, though, is just having the fund in the first place. I'd rather you have a larger fund earning less than a smaller fund earning more. Not because I don't want you to earn more, just because it's the size of the fund, it's availability that matters. But yeah, at call, high interest. It'll be an online account. You can transfer it out within a couple of days, and it should be relatively straightforward. So that's an option. In a perfect world, do it with your current bank that's also got your transaction account linked to it. Why? Because you can transfer that money instantly. If I got to transfer money on with Australian Mutual Bank for what it's worth, if I had an ING account, I'd transfer money from there into my Australian Mutual Bank account. It might take a couple of days. So that wouldn't be ideal. If I needed like proper emergency with the money stuff, you're probably not going to. You're probably going to be okay. But if you get a high interest at call linked to your current bank, do that. If you can't, then get something externally and do it that way. I hope that helps. There's not many features you need to more than that, honestly. Internet access, ease of transfer, not locked up for any length of time. Just be careful, by the way, last quick one, careful of those bonus rates, the kind of introductory rates. They grab you with a nice idea, hey, you get 5% for the first 90 days. And if the next line is, and 2% after that, go for the one that gives you 4% the whole time. Just makes sense, right? So that's straightforward, I hope. Just don't get sucked into the marketing lines. Make sure you read the detail. Okay, Ray, why might a company distribute, how am I going for time? Pretty good, actually. Surplus capital way of a special dividend versus a share buyback. There's two ways to answer this, Ray. Why do they do it and why should they do it? And I know that sounds like the same thing. I'm not trying to be a clever so-and-so. But it's also important to be a little bit skeptical sometimes. Why should they? Okay, if I owned Phillips Enterprises and I had an extra $1,000 to give to shareholders, right? I'm not a particularly good business, so let's assume it's a small dividend or a small amount of money. So I saw surplus cash. What can I do with it? Well, I can pay it as a dividend. I can buy back shares, or I can actually invest it in growth. So you've got to decide as a company manager, and then as frankly as a shareholder, what do you want? If Phillips Enterprises has a beautiful, bright future, you might say, no, keep the money, invest it in growth, because I want Phillips Enterprise to be worth more next year. I want to see lots of growth. You might say, you've kind of tapped it out, mate. You're in a niche market. You're not very good at what you're doing. You made some money. Let's not spoil it. Give it back to the shareholders. In that case, your question comes into play, which is special dividend, or any dividend really, or a share buyback. A share buyback should be entertained by a company when the company's shares are cheap. Why? Because if let's say I had $1. Let's say you had $1, And I had 80 cents. I said, mate, can I give you 80 cents for that dollar? You're like, yeah. I'm like, I'll give you 80 cents, you give me $1. Yeah. Okay, let's do the deal now, right? Why does that work with a share buyback? In the case where a company thinks its shares are cheaper than they should be, in other words, they should be worth $1, but they're selling for 80 cents, you want to buy those back as quickly as you can with your dollars, right? Because you're going to buy more of them, and then they go up in value, and you've made value for your remaining shareholders. So you buy back shares, or companies should buy back shares when the shares are cheap, because you create value for the remaining shareholders. When should you pay a special dividend instead? Again, the same thing in reverse. When you can't buy back the shares cheaply. In other words, I've got $1. As a shareholder, you want some spoils from it. If my shares are trading $1.20 in the example, I could buy those back at $1.20, and you're like, dude, they're overvalued shares. Just give me the $1, please. And so I give you the $1. You say, thanks very much. I got $1 for my $1. You didn't waste it on buying back overpriced shares. Now, it does require a company to have some view of its valuation. It should, if it's half decent. Capital management is one of the most important roles of the CEO and the board, so they should know, but that's the answer. Honestly, these days, companies buy back shares just to kind of try and show the market they think the company's undervalued, whether it is or not. So be really, really careful. This is why you've got to trust the management team. Oh, I was going to make some grandiose statements. I was going to say, in general, I prefer dividends to buybacks. Not because I don't love buybacks, I do. Berkshire Hathaway, I mentioned that a couple of times this week. I'm a shareholder. When Warren Buffett buys back shares, I know he's using that money well, right? I'm stoked he's going to do that. I hope he does as much as he possibly can when the price is right. Now, the last quarter, he didn't buy back any shares. Why? Because he didn't think the price was cheap enough. That's exactly what a management team should do. And if you look at the banks in particular, they have those buyback programs so regularly. And you kind of go, guys, what are you doing? Like, if they can't be cheap the whole time. Either it was cheaper the last time, or it's more expensive this time, or when the price goes down again. There's lots of jiggery pokery going on where they try and look impressive. They try and return capital to shareholders. It sounds like a smart thing to do. They should be paying special dividends when the shares are expensive and doing a buyback when the shares are cheap. Okay, Hal says, no financial advice, thank you, Hal. But CommSec Pocket and BetaShares Direct are brilliant low-cost products. Your way you can schedule small amounts to dollar cost average, low risk, a nice way to enter share investing. There you go. I've never used BetaShares Direct. Vanguard apparently is also pretty good, I'm told. I haven't used CommSec Pocket, but I've used CommSec and they've always been good. Are they the best? Probably not. Are they good? Yeah. Are they worth using? Yeah. There you go. Great. So if you want to look at some other options, CommSec Pocket I mentioned, BetaShares Direct. Thanks, Hal. Appreciate that. Salary sacrificing from Simon. I'm going to hopefully look this up because I think I know the answer, but I would hate live to get this wrong. So I'm going to Google it while I'm speaking. Salary sacrifice super. Dear. Contribution caps. Looks like $30,000, I think. There you go. Yeah. Check on the website, mate. I'm sorry, I'm being really vague. Yeah, I'm gonna not answer this one directly. Oh, here we go. From July 1, 2024, the general concession contributions cap is $30,000 for all individuals, regardless of age. Good, I got there. Apologies for having to look on that one. I wanted to make sure I was right. It does include your employer contributions, mate. So you need to estimate. Now, we know the percentage of your salary they're contributing, so you should be able to do the rough maths and do it. If you contribute extra, I'm pretty sure the ATO still lets you either withdraw that back out or pay just extra tax on the extra contributions. You can do either depending on your financial situation. I have done both in the past. No, I haven't. I've never actually withdrawn. I've always paid tax on the extra if I've gone over. That's just me personally. Once it's there, I never want to take stuff out when I'm investing. Whether I've contributed money to my own savings account for investing or I've made some super contributions. I think it's happened twice that I can recall. And it wasn't by much, and I just paid the extra tax. But yeah, $30,000 a year. There you go. Hal's already answered that. Thanks, Hal. Vince says, do you offer personal financial advice? We don't, unfortunately. We're not built for it as a business. It requires, I got to say, financial planners, they're both more and less necessary than they seem. They are great for structure. They are great for coaching. They are great for getting on the straight and narrow. They're great for all that sort of stuff. The problem for them is to do that, particularly do the advice, the paperwork that's required, this admin staff, whatever. Most financial advisors won't take you unless you're paying less than more than $2 or $3 grand in fees up front. It's really prohibitive. Not just their fault. The industry is structured that way. The bureaucracy is structured that way. I have my thoughts, but I won't do them here on what they should change. So it's just not economic for us to do it. We're not really geared for it. We call ourselves one to many. In other words, we kind of do general, broad financial advice. If you want to find a financial advisor, go for one that only charges you a fee, doesn't get anything back from any investment that you're part of, including the dealer group of that financial advisor. And Pay them up front for advice. If you want them to manage your money, you can. Just be mindful they're going to charge you a large amount every single year. I talked about fees before. They can get really expensive. If you've got a lot of money, maybe it's worthwhile. If not, pay them up front, get some really good advice, some good structural advice, and then go implement it yourself if you're comfortable with it. If you're not, that fee can be well and truly worthwhile, right? If you make a massive mistake, you're better off paying the fee than not. If you can do it yourself, think twice about paying a very, very large annual fee ongoing, unless you're getting value from that. If you are, then great. Some people just love to be able to sit down with a financial advisor once a year and go, am I on track? And he or she says, yep, you're good. You go, oh, thank goodness. Okay, well, that was worth the money. If that's you, then again, go for it. Do what's right for you. It's not as necessary as it is made to seem, but is valuable, particularly the setup and the coaching. That stuff is really important. Okay, so Simon and Hal were chatting backwards and forwards. Well, I was banging on. Thank you, guys. Appreciate that. As a novice, I'm reading The Intelligent Investor, updated version. Yeah, definitely the updated version. Can you recommend any other reading material for novice investors? Yes, absolutely. I have lots on the, I'm going to do, you're not supposed to turn your back on the camera, but let's do this for fun. I got lots of stuff over there. You can still hear me because the mic's on the lapel. I go to focus though. If I move out, I think it'll probably focus in on those books, will it? Look at that. How goes the camera? Lots of good books there. So from here, the very best, not on the left-hand side deliberately, The Essays of Warren Buffett is the book I recommend you read next. The Intelligent Investor was written by Buffett's mentor, Ben Graham. You can't quite see it actually because it's a bit high on the screen. The Essays of Warren Buffett is Buffett's letters to his shareholders, put together by category and topic, and chronologically then through time. So topic first, then chronologically. You get lots of great content. It's a business MBA and an investing MBA. Do that. What else? Any of Peter Lynch's book, Beating the Street or One Up on Wall Street, are excellent. Phil Fisher, Common Stocks and Uncommon Profits. It's an older book. It's lots of old examples of old US technology, like old technology companies, photocopy and calculator companies and stuff, but really, really worthwhile. The one I do recommend you read is Good to Great by Jim Collins. It's not an investing book at all, it's a business book. But it talks about, particularly if you're going to start moving from ETFs into individual shares, I think you can. I won't say you should, you don't need to if you don't want to, but if you want to. Great, one of the absolutely seminal business books, and helps you identify good businesses or great businesses. That's what you're looking for, right? You want to find the best businesses to invest in. You've got to pay a good price, and valuation's a whole other topic. But finding good business, Good to Great, is just spectacularly good. What else would I read? I'm going to turn around again. It's really uncool, but I'm going to do it. In terms of investing, there's lots of business books, and they're kind of interesting from a business perspective, but not necessarily, not going to help you be a better investor. One. This one. I'm going to try and hold up the camera. The Little Book of Behavioral Investing by James Montier. I hope that you can see that one well enough. It's a really, really great book. One of the things we haven't talked about this session, I probably should do next time we talk, is how's my microphone technique? Horrible, is it? We didn't talk about psychological biases a lot. But the field of behavioral psychology, and then the finance offshoot of that called behavioral finance, is so incredibly, incredibly important. I've tried to talk to you about that with pre-commitment devices. I've talked about that with volatility, talked about a whole lot of other areas, trying to do some of that. But behavioral psychology, the things that we, our biologically or evolutionarily, what's the right word? Underdeveloped brains, society has developed faster than our brains. In terms of our emotions, our instincts, we are still instinctively on the savannah. We're still instinctively reptiles, right? And society's moved on so fast. I mentioned the other day about the fact that that there's nothing in our evolution that says save for the next 40 years. This is not right. You save some wheat for a couple of months. You might save some tomatoes to get you through the winter. You're not saving for 40. It just doesn't exist. And then, by the way, when things get scary on the savannah, you run away because you hear a lion. You're not going to hang around and find if it really is a lion, or if the lion's only going to take a small nibble out of you, right? There is no. I don't think, I'm pretty sure I'm right to say this. There's no evolutionary parallel for investing, modern investing, and that's why we've got to take control of those behavioral biases and overcome them. The Little Book of Behavioral Investing is excellent, really well written. It's short. It's really, really short. It's literally a short book, but it's thin as well. Really, really well worth reading. So, The Intelligent Investor is great. The Letters of Warren Buffett are fantastic. Peter Lynch, One Up on Wall Street, Beating the Street. Phil Fisher, what else did I say? Jim Collins, Good to Great, and James Montier, Little Book of Behavioral Investing. Well and truly worthwhile. By the way, this is going to be posted on the site. If you want to rewind and write them down slowly, you can do that once the video is finished. All right. Hal asks, mate, do you recommend hold US shares directly or stick to local ETFs in Australia? I find the currency change and tax obligations can at times be fiddly. I own about half of my portfolio is invested directly in the US, about 50-50. Not deliberately, by the way. Yeah, just that's the way it's kind of right now. It's almost, oh no, the US is actually ahead at the moment. It's probably 55-45. So yes, I own direct shares. Berkshire Hathaway is my largest shareholding. Amazon's my second largest. I own some others after that one. There's probably 8 in total. The currency and the foreign exchange can be kind of fiddly. Record keeping can be a little bit fiddly, but it's actually not as hard as you think. Now, by the way, if you want to stick with a ASX listed ETF that covers US stocks, go for it. That's all you need. So I'm not going to bang the drum. So you must invest internationally. But I would say investors should be exposed to markets outside Australia. So if I was going to hold individual US shares, I'd have a much larger holding in a ASX listed US ETF or an international ETF because I want exposure to those markets for the growth potential, for the quality, for the diversification. 3 good reasons. I hold them directly. I trade really infrequently, particularly in the US. It is a bit of a hassle, right? So I don't send money over there. I don't dollar cost average into the US as regularly as Australia. I would usually put a lump sum over there every so often and then invest that money. It's a little bit easy, right? You're right to do it less frequently, but I almost never sell. I can't remember the last time I sold any US shares. The Motley Fool's got some rules. I actually can't sell something I've recommended. So that's one of the things that stops me selling too frequently. But even then, I'm just not a seller. So yeah, ages ago. Contributing that, I mean, money at one point, you transfer some money today from here to the US, you buy the shares tomorrow. The exchange rate's pretty clear. You just write it down or write down the date. You can always look it up. Apparently, ATO's got a currency chart that the accountants use. Certainly my accountant does. So he kind of uses that. So all I do is say I bought shares of this company on this date, and that just is what happens. If you're doing it yourself, it might be a little more fiddly, but I really don't think it's that much more fiddly, and I wouldn't let it stop me investing in the US. If that was my only option, I'd happily do it. But again, I'm not beating the drum on individual shares if you don't want to. If you're happy to own a US ETF on top of your Australian shares, that's a great way to do it. It'll do perfectly well for you. Make sure it's diversified, as I said before, low cost, diversified, broad, all that kind of stuff. Index-based ETF. I own units in the NASDAQ ETF for the record. I own units in, I think, US Total Market, and I in units in a Vanguard Global ex-Australia, which is basically US plus others. So they're the 3 I happen to own. Some, all personally, some for my young bloke, some for our own portfolio. We do kids that investing the other day, actually. It's a fun topic as well. But yeah, so I wouldn't not do it for those reasons. But if it is a sticking point for you, I'd rather you at least invest in an ASX listed US ETF than not do anything at all, if that's the decision. But it sounds like you're on top of it. Do I have stock picks for US shares or only NASDAQ shares or AI shares? So I'm not sure entirely I know what you're asking, James. I think you're asking whether we recommend US, I don't know. So I think you're asking about the Motley Fool services. If you are, it's not an ad. Most of our services buy or recommend ASX listed stocks. We have one that does specifically US stocks, and one I run called Share Advisor does both ASX and US stocks. We have done AI report recently. The AI report was for some of our other services. I think we used it for Extreme Opportunities and Stars and Stripes, which are US service when we opened them, as kind of bonus content. Kind of sign up and get this bonus report free. But we don't have an AI service that we're opening to new members, so we don't do that specifically. I think that answers your question. I hope it has. If it hasn't, ask me again. Okay, Elizabeth, has the drop in the Australian market recently had more to do with our economy or US politics? And the $64 million question, where will it land in the next few months? I reckon, Elizabeth, you know me well enough to know I don't know you, by the way, personally. Know me well enough to know I'm not going to make a prediction about the market for the next few months, but I will talk to what's happening. Yeah, I suspect, honestly, mate, it's more to do with US recently. We've seen some big falls in US markets. Actually, two parts. That's not just US. So we've seen some decent falls in the US markets. The US market overnight fell because Donald Trump announced that tariffs would start on China, Canada, and Mexico tomorrow, and China's getting another 10% because the first lot wasn't good enough. So that was announced, and the market was actually flat and fell 1.6%. I think was in the end. Literally on the back of that, you can see the market's twiddling and then bang, just goes down like that once he makes the announcement. So yes, US shareholders investors are worried about what the tariff war will look like for US companies and global companies. I think that's fair. I think we're probably getting a little bit of that as well. I will say, actually, part of what's happening in the Australian market is more than half our market is banks and miners. And over that period of time, we've actually seen the banks, I think at least 3 of the 4 of them, delivered really disappointing earnings results. Betting on Adelaide Bank was down, NAB was down, CBA down or flat, can't remember. Their shares, they fell really significantly. It was rough week, a week and a half for the banks. And the miners, BHP, Rio and Fortescue, all had lower dividends and lower profits because the iron ore price was lower. That was all announced. It's earnings season, right? So it all gets done in February, or mostly. That was announced over that 2-week period. And because it's half our market, the banks and miners, or finance and resources more correctly together, more than half our market, when they take a bit of a dip, the market takes a bit of a dip. So that's probably the answer. If you own those shares or you own the market as a whole, you're going to suffer from that. That's just kind of the way these things go. A couple of thoughts. Still be diversified locally and internationally, as I've said a million times, because you don't necessarily suffer from that. Diversification is not going to protect you from downside risk, right? Or from volatility. It's just not. I mean, you can diversify in stuff that doesn't go down. You diversify in cash, for example, but then cash doesn't go up either. So you kind of want to be careful what you wish for. If the market goes up 9% a year over time and cash stays flat, well, you get some interest, I suppose, but you know what I'm saying. The longer you're in cash, statistically, the further you are likely to be behind the market. Now, you might be okay with that because, like, you know what, I hear you, Scott. I'm happy to take a lower return because I just don't want as much volatility in my portfolio. That's fine. Just recognize you're making that trade-off. Why am I saying this? I'm no less interested in investing today, or no more interested in investing today, maybe a little more actually, than I was 2 weeks ago, because I'm looking at that long-term horizon I talked about, the 5-year plus view. So, 5 years' time, Donald Trump's not the president anymore, short of a constitutional change in the US, and hey, don't rule anything out. He's passed over to somebody else. Companies have done better in different things. Competitors have done stuff. Economies have done stuff. It's really, really hard, but really, really important to ignore the short term, because all it's telling you is, again, remember we said the other day, in the short term, the market is a voting machine. All you're doing is saying to people, how do you feel today? I feel great. Shares are up. I feel terrible. Shares are down. That becomes self-fulfilling sometimes, by the way. So that's where you get losses in a row or gains in a row, because everyone gets excited or everyone gets pessimistic. Over the medium and long term, it's a weighing machine. It's weighing up the real underlying value of this stuff, right? Fool's gold, no pun intended, versus real gold. The actual fundamental value of a business is not the day-to-day sentiment of I'm excited, I'm disappointed. I'm excited, I'm disappointed. It is long-term value based on its profitability and its future prospects. That's kind of a bit of balance sheet, but that's pretty much what you're thinking about when you're thinking long-term. Diversified on gold 5 years ago. Yeah, well, hindsight is wonderful. I wish I had that hindsight too. I know exactly what I'd buy and exactly when I'd buy it. I wish I had that opportunity. If you find a time machine, Elizabeth, hit me up. You can send me an email. We'll talk. Okay, Steve, what platform do I buy using US direct shares? I use Charles Schwab, but I will say they have now, I believe it's still the case, a $25,000 starting deposit. They don't want to deal with smaller investors. Now, I actually rolled into Charles Schwab because I had an Options Express account. Schwab bought Options Express, so I didn't have to put that money up front. So that's one I use. It's good. It's perfectly fine. It's more than enough. But most people offer international options. Their Stake is out there. CommSec has an international platform. Sharesies, I'm pretty sure you can buy international shares directly through their standard platform. So yeah, lots of options. Again, I'm not recommending those through. I'm saying they're available. Schwab is good. Depending on how much money you're investing, if that 25 grand is real and is a blocker for some people, and don't do it. Obviously, if you have more than that, if you're lucky enough to have more than that invested, that may be an option for you. We want to put a lump sum in there. But yeah, check out Sharesies, check out CommSec, check out Stake. There are 3 options that come to mind. There'll be others out there too. Just be really careful the further you go outside the known names, not because they're not good businesses, just because you don't really know. The one big, it's not even a red flag, thing to be careful of is, remember what I said, I've said this a few times, brokers make money by making you trade. So be careful of any broker that's going to try and keep giving you trading ideas, right? They're trying to incentivize you, goad you into trading. Please try and avoid that as much as you possibly can. Don't overtrade. Buy to hold, be a long-term investor. Try and buy more than you sell. Try and buy frequently. And that's always good, keeping brokerage down every month or so, or every quarter, whatever's right for you. But trying to let them convince you to buy, sell, or take a position on this, or here's the new latest hot thing, right? Some of the brokerage platforms out there offer, hey, here's what everyone else is buying. Why? It's called social proof. Again, speaking of behavioral biases, if everyone else is doing it, remember what our mum said? If everyone else jumped off the harbour bridge, will you jump off the harbour bridge, Scott? No, mum, I won't jump off the harbour bridge. Just everyone else is trading and hyper trading and being silly. Don't be silly. Be the tortoise, not the hare. If an income investor asks how looking fully franked yields, should you avoid ETFs that appear to lose capital value with each distribution paid? Yeah, but do that anyway, whether you're looking for income or not. Yes, you're right, mate. You've hit on something really important here. Some ETFs are paying you a higher return, pretending that it's a higher return. It's coming as a result of capital value, right? If I chopped up my second bedroom for firewood, and then say, hey, I've got those income from firewood sales, well, yeah, your house is worth less. Not worth doing, right? So you're absolutely right. Really good intuition, mate. Yes, but also to remember I talked about broad index-based ETFs. I really shy away from anything that's trying to be too clever. Why? Because I just don't reckon you need to be, and it adds complexity, it adds risk. Some of those income ETFs are built using options trading strategies and stuff like that. I don't want to play that game. We have, as I said, an income service called Everlasting Income. We just hold ordinary shares, and they pay dividends. And we tell our members, hey, you got some money, pay it out to yourselves, and go and pay the bills. We could do options trading strategy, we do all sorts of stuff, but it's not a good idea, I don't think. So be careful of any high yield ETFs, that kind of stuff. The other thing about, by the way, quickly, high yield ETFs, they tend to concentrate in the higher yielding companies, which is fine, except when you realize that, for example, while the banks are, I said the banks and miners together are half the market, banks themselves, I don't know how much they are, I overstated. I'm going to say 30%. I'm probably right, 5% either way. They will hold 50% banks in this high yield ETF. Why? Because they're the highest dividend payers, which is lovely, except you're taking really serious concentrated risk at that point. So be careful chasing the ETFs. Do a great job of marketing. There's a, I think it's electric vehicle ETF. The code's ACDC, right? Cool, right? Cybersecurity one called Hack. What I said the other day. They're good marketers, and good on them. Good luck to them. Don't get sucked into the hype. Buy it if it's right for you in your portfolio and your circumstance. Excuse me. More broadly, stick with the plain vanilla, broad index-based, low-cost ETF. Go fishing. Superannuation may provide diversification with growth and balanced investments, says Keith. Yes, it absolutely can. I've read yours, Hal, while I was answering. Sorry, I'll go to Keith. I'll come back to yours. Yes, superannuation may provide diversification for sure. We talked about superannuation yesterday. I talked about the different options to invest in. Be mindful of how you do that, but absolutely, mate, you can manage your portfolio however you want. I wouldn't try and diversify personally on growth versus income basis. If you need income, you need income, right? So I get that. And some people do and they want it. Other people don't want income. They want to buy these hot stocks that go up to the moon and they get all the returns out of price. That's cool too. I don't love capital letter investing, capital G growth or capital V value or capital I income. If you want to tend your portfolio towards income generation, go for it. Just be careful about how you do it. I mentioned the banks before. Same with growth, right? Chasing growth, yeah, that's cool. Value in the middle somewhere. Buy cheap stuff. Well, it's only cheap if it goes up. Now, it's not that I don't buy cheap stuff. I do. Sometimes I think it's going to go up. But don't chase the capital letter investing styles is my advice. Find a way that works for you. But you're right, mate. Using super in that way can be absolutely a way to diversify your investments. Can get a combination, a bit of both, right? As the old meme says with the little kid, why not both? That's kind of where you end up with if you try that strategy, and that's perfectly fine. Remembering, of course, as I said before, maximizing your returns is what we're kind of after. We think we are, and that's right. But if you take so much risk to potentially maximize your returns and get worse returns, you haven't maximized them after all. And I know you know that. I'm talking about you, Keith. I'm talking about people in general, right? Think about the way you're investing, the way you're thinking about this. You want to, firstly, be alive at the end. Don't go back to square one. Don't get killed on the journey. So be alive at the end. Secondly, maximize the eventual return, not the potential return. In other words, hey, if I go to the casino, I bet on 28 black. I don't know if 28 is black. Let's assume it is. I could maximize my returns by making, what's the odds? 36 to 1, something like that. I can make a fortune. Sure. Is that likely to maximize your actual returns? No, you're going to lose on average. And again, I know you know that, but it's a good way of using that example. Risk sounds exciting when everyone's taking it when the market's going up. On the downside, you're like, oh man, I shouldn't have done that. Shortcut that for your own sake. I'm not saying don't buy growth stocks. I love companies that grow. Just don't chase stuff. Don't take undue risk. Don't take more risk than you need to just because you're impatient. You want to get there more quickly. Hey, Hal says, help others find Scott's awesome videos. Your words, Hal, not mine, but thank you. The algo loves it if you hit the like button. So there is a like button just under where I'm speaking here. Someone's done it. Thank you. I'm going to use the Motley Fools account here as well. There you go, 2 likes. Also, too, please do hit the subscribe and alert button, all that kind of stuff if you can for the channel. We've got heaps of great content coming out, but again, I'm not going to plug it. If you want to, I've told you about it. So if you want to do it, go for it. If you don't want to do it, then don't do it. That's cool too. That's it. We made it to 1:30 Eastern Daylight Time on Friday, the 28th of February, the very end of Financial Literacy Week. Thank you so much for being part of this. I genuinely mean it. I mean, I'll sit and talk to a camera with no one on the other side if I have to, but I love that you stayed and you watched. Thank you very much. Thank you for the great questions. I hope I did a reasonable job of answering them. Please go back and you look at the videos. Please refer your friends to them. I don't think we're ad supported on this channel. If I am, I apologize in advance. I don't think we're ad supported. If we're not, then I get nothing. If you click on it, watch it. Maybe the algorithm likes it or something. But I want friends and family to see it, right? I do this because I love helping people. I famously said years ago, I won't draw this out. I took a pay cut to join the Motley Fool in 2011. I'm not asking for plaudits or bouquets, but I did it because I really wanted to be part of what the Motley Fool was doing. Because I was a customer, a member before I was an employee. So that's why I'm here. That's why I'm doing this. That's why I'm doing this video in particular. And why the team are, as I said, I'm just one of a team. We really want to help people genuinely because it's worth helping them. So yeah, there's that. After this, thanks, Simon. Thanks, Horse King. Thank you, mate. Thanks, Hal. Go the Storm. Come on, dude. You were doing okay until then. I even liked you a little bit. The Roosters, of course. Thank you for watching this video. You will get an email from us. We do have an offer for ETF Investor, and a service that I run. If you want to find out more about ETFs, we can do that. $29 is just stupid cheap. So if that's useful to you, you'll see an email from us. If it's not, don't worry about it. Ignore it. That's fine. Marketing, I'm not supposed to say that, but sorry, marketing team. If it works for you, if you've liked this, if you want some more value from us, go for it. If you don't, that's cool. Don't just ignore it. There's no obligation. We've done this free of obviously kindness for our hearts, but there's no expectation, no quid pro quo. If you like it, you want to get more, do it. If you don't, that's cool too. No harm, no foul. Please do subscribe to the channel. I will see you very soon. Enjoy your weekend. Thank you for watching. Thanks for spending the week with me. I really appreciate it. Fuller.